So when we look at interest rates, we can't stop today without talking about interest rates
Right.
and how things have changed. I know you were author back in November of an article that was, I think, in Real Estate Assets or one of the trade magazines. It was talking about the 60-40 portfolio being broken, and 60-40, 60 stocks, 40 bonds.
Right.
Interest rates killed the bonds.
Everything went down.
Everything went down. So people are then looking around, I need some non-correlated assets.
Right.
And so that's something that we see in the investment advisory side of the our sister company. People are looking around for what do we have? If it's not 60-40, what are we going to do? What's non-correlated? And that's really where we get into the alternative investments.
Right.
So let's say that you, just to give an example, 4 years ago, you bought into a multifamily, and they had projected maybe 2% a year growth on rents.
Right.
And now they're seeing inflation where rents are going up 10%, 12%, 15%.
Right.
In a master lease environment, the structure of that is going to flow through.
And it goes back to, again, the quality of the sponsor. If they underwrote the property at levels that were not appropriate and not sustainable, then that DST is going to miss the mark, right? So, you also want to be careful of saying, boy, this operator thinks that they're going to raise rents 10% per year.
Right.
That's just not realistic on a long-term basis, and you can't count for that being the case. To your point, on the opposite end of the spectrum, you see DSTs that were underwritten, I think, conservatively and hopefully appropriately, that have outperformed those numbers and are able to actually pass on greater cash flow to the investors. But that's not true of all real estate assets, right? If you have a 25-year lease with either flat rents or maybe 1% to 2% contractual increases, it becomes much more like a bond, and that type of real estate maybe doesn't perform as well in an inflationary environment. That's why sometimes it's good to diversify. Maybe a client has some longer term net lease assets that are going to be stable, and hopefully good times and bad will continue to generate cash flow, and then potentially some shorter term assets like a multifamily, a self-storage, that are going to hopefully have a little more horsepower during inflationary times.
Well, when we sit with a client and we're trying to figure out what to put in their portfolio, my father used to joke that one of the first things they teach you in medical school is how to say it depends. Right. Who of us haven't heard that when we ask the doctor about a specific answer? But the same with real estate. Which DST would be best? Well, it depends. Are you solving for, maybe you have so much income from the last thing you need is more taxable income. Then maybe you go into a highly leveraged position instead. Let's say that yield is the most important thing. Or you don't have kids. Okay? You don't have any heirs that you want. So it really does come down to what's important to each client.
And again, to your point, I had a situation a number of years ago where the client decided not to go into a DST. They bought their own single tenant net lease asset, and their attitude was, it's a 20-year lease. I don't care what happens at the end of 20 years. I'm going to clip that coupon for the next 20 years. Sure. And if I walk away from this property 20 years from now, from a risk standpoint, they felt they were better off. Other investors take the exact opposite approach, which is, hey, if I'm not growing in my real estate value, then I'm losing ground because of inflation.
Yeah. So, DSTs, if it's just plan to hold it and let the next generation deal with it, then it is more of a bond-like. And again, the strength of the sponsor, the cues, the quality of the sponsor, quality of the property, quality of the income is what's going to be important there.